So we got some cross currents here to deal with, but we do know that the U.S. and China spoke by phone. And after the Huawei CFO arrest, some say maybe you'll take that.
We'll take it for now, but I think it's an example of every day that the market's going to trade on the different news on the trade side. And so today it's great, might not be so great tomorrow.
What's your take on this, and how constructive do you read it?
Well, certainly talk is better than no talk. There's no question about that. But if you're a professional investor in particular, today is a perfect example of why you've been pulling your hair out the last couple of months. You've got news on China in the morning. You've got a major CEO of a technology company testifying in front of Congress. You've got a Brexit vote. There's a number of things. And so it really makes it more difficult to think about stocks fundamentally. But the backdrop is that the consumer is in good shape.
That being the case, though, there have been times when the market has been perfectly able to shake off all the policy stuff and all the noise about trade or budgets or something like that. And I wonder if it's because right now what's in front of us in terms of fundamentals is a slowdown, potentially at least. I mean, how do you play that?
So right now we see the economy in 2019 being good enough to support the markets. The issue is that the market's looking for the degradation in the second derivative, so slowing rates of change. And I think Friday's job data is a perfect example of, as we get the degradation in the growth rate, the market's going to respond to that. So you're really in a trading range of 2,600 to 2,800, and to really see this rally
on the
S&P, you got to push through 2,800, and you've got to do it decisively.
Julian, can you still trade on statements out of the White House the way you used to? I mean, expect that they're vetted with the level of accuracy that they have been in the past. I mean, I'm reminded of just a week ago, the mixed signals about what exactly was going on between the U.S. and China. It seems like in a vacuum of information, at least in the short term, traders should take anything, but does it stick?
It's pretty hard not to argue that the decibel level and the confusion level has risen since the midterms. So in that respect, it really is hard. And you shouldn't be doing it anyway unless you're a professional trader in front of the screen. If you're a member of the investing public, the thing is to really get comfortable with the fact that we're going to swing 300, 400, 500 Dow points a day. That's the way it is in this environment. But that ultimately, the economy, even though it's going to be slower, in an absolute sense, is still strong enough, particularly if we get some help from the Fed, that stocks will be higher next year.
All right, so we got this softer rate narrative, right? We got this G20 truce and talks are back on. UBS today says redemptions are near peak. So would you be using all this volatility to add to positions?
We would. To us, at this point, again, given the fact that the backdrop it looks favorable, albeit slower, and the fact that sentiment on the part of professional investors is as sour as it is, which is a contrarian indicator, to us, this is part of a normal sort of bottoming process for a typical 10+% correction that you've had since the start of 2009. This is number 6. So we would look to be adding here.
Obviously, Alicia, we've had maybe half of all S&P stocks down close to 20%. A lot of value has been kind of knocked around here. What does it mean for you to try to position coming out of it? And what are you looking for as signals? I mean, yesterday, big tech was a bright spot. Credit markets were okay for a day.
Right. So I'd look at credit markets, but I'd also look at one of the most hated sectors of the market right now, which is financials. So financials have been the pain trade for this year, in part because of the flattening of the yield curve, but also concerns about growth, because after all, the economy is mediated through the banks. If you see the financials trade up, and if you see credit spreads come in, particularly in high yield and the BBB sector, I think you're okay.
Alicia,
you need to see it in the credit markets also.
How do you read what's happened in big tech? Because on the one hand, a lot of those names have seen that 20% drop that Mike just mentioned, but at the same time, Amazon's still up better than 40% for the year, Netflix better than 40%, Microsoft about 30%, but Google is pretty much flat. So it's like some high valuation stocks have remained high, while some of the ones that had been chugging along, just making numbers, have suffered. How do you parse that?
So I'd go back to what Julian said earlier, which is, you've got Google in front of Congress today, and I would sort of unpack FANG, because I think FANG has been defanged. You can't look at it as one sector anymore, and you have different business models with different revenue streams, and the business models that do not monetize their customers are the ones most at risk of political risk. And you've got an alliance here between the Democrats in the House and the administration that has an interest in regulating this. And that's why you see the difference in the multiples, and that's why there's certain parts of tech that can still go up.
Interesting. As you're saying that, Twitter's our #1 S&P-er right now, up 5%, which has had a bit of a run lately. But I wonder if you think if FANG gets squeezed in all sorts of areas, whether incremental dollars, marginal dollars go to some maybe second-tier players in social media and search, things like that.
I think social media is a problem. I think you'll see it more in the cloud area, and I do think you will see some recovery in the hardware as long as the trade issue stays good enough, right? So you can't have Lighthizer and Navarro in front of the camera and at the table every single day.
Julian, I know you keep an eye on the sort of derivative side of things as well. What do you make of the volatility index is at 22? Now, of course, the market itself has been super volatile, so that's been carrying it higher. But in December, normally it kind of drains away a little bit. Is that sort of a warning signal? Does that reflect that environment you're expecting about more wild swings? Or does it reflect an excess of caution? What are we to make of?
Well, it reflects the uncertainty with all these events that are around us. For instance, Trump, Schumer, and Pelosi are due to meet in about 15 minutes. What's going to come out of that? Obviously, you have concerns in Europe and so on and so forth. So it is typical for volatility to be more subdued in December. We expect as you get closer to the end of the month that will happen, but you've got to get through the Fed in particular in first.